Tribe Technologies is a provider of property management technologies and services and is consolidating the North American property management industry. The company just reported Q3 2025 financial results, and CEO Joseph Nakhla is here to discuss and provide an update on the company's operations. I'm Martin Gagel with Market Radius Research. Please remember, this is neither recommendation nor investment advice. We're here to learn about the company. Joe, great to see you. How's it going?
Awesome, Martin. How are you?
Very well, thank you. Very well. Why don't you give us a quick overview on the quarter, and then we can dig into a couple of things.
Yeah, absolutely. We had a great quarter, just in continuation of what we've been down the street. We were set out to do a great revenue line, continuation of us hitting another record year, probably track record to about $33 million of recurring business. This year, we had a fantastic improvement in our gross margin. Obviously, we're driving hard towards profitability, and by looking at this slide here, if you look at the first 9 months of 23 versus 24 versus 25, you'll see that we continue to execute both on the revenue side, on the gross profit improvement, as well as our adjusted EBITDA. We still anticipate to finish the year with a solid adjusted EBITDA, and we've also made a massive dent into our paying back our vendor takebacks or debt. We're down to $1.9 million in vendor take-back. It was about $5 million a couple of years ago. And so we're very pleased with that, because that's an indication that the model is working, that the assets that we've purchased are well integrated, hitting the right EBITDA numbers, and we're actually paying back those vendors. So very, very pleased with the year, and we're well on track of what we told the street we were going to do.
You did a really nice job on your margins, both your gross and then your adjusted EBITDA. What was driving that? Like cost controls, a product mix? Can you flesh that out a bit more?
Absolutely. For our new viewers that may not know enough about us, we are set out to disrupt really the way condo communities are managed and rental communities are managed. We have two big divisions. We think of a big REIT that manages a large portfolio of rental buildings. They come to us, we manage that on their behalf. Or think of these condo corporations, i.e. stratas, as we call them out west, these big condo buildings and towers that grow around you in the downtown core. We manage those as well. And we go tech first, so we digitize these communities, we put all of our technology in there, and then we also provide them with the guidance towards how to spend their maintenance fees and how to prepare for the future of these communities. So we have multitudes of touch points with these communities. The biggest difference that you're seeing here is that we went out to build a national footprint. It's very unique. We started this on this journey. We had no assets under management in 2018. Today, we're up to $42-43 billion of assets under management. Not to impress, just to kind of give a little bit of perspective of the growth. So now with a national footprint, we're the second largest rental management company in Canada, and we're the third largest condo management company in Canada. So with that context being provided to everybody, we needed to make investments into our national footprint, and now we're backfilling into that national footprint that we've built. So when you look at our revenue, that's a function of us acquiring more traditional property management companies and adding them to our mix, plus our organic growth, that more and more buildings leaving traditional property management companies coming to us. And then you'll also see significant improvement in gross margin, simply because when we buy these traditional property management companies, lots of opportunities for us to improve the operations and improve the gross margin lift. And then that also translates, since we've made our big investments into the national footprint, you'll see now our EBITDA numbers continue to improve, and it's very much right on trend, as you're seeing here. We expect 26 to be a fantastic year, and we're going to be generating cash.
There are two aspects to it with your platform. Is one, you're able, through efficiencies, digitization is just run more efficiently, but you're also able to sort of sell on additional value-added services to your buildings, and that. How are, compare both of those sides going? I would guess the cost controls or the expense consolidation kind of comes first, and then you slowly build on the revenue adds to that?
Yeah, well said. I mean, if you look at the composition of our Q3 results, you'll see about 82% is sticky recurring business, and about 17-18% of our transactional revenue is what you referenced, like digital services and selling onto the building other products and services. The year to date is going to be the 80-20 rule. 80% of our revenue comes very sticky, recurring, and 20% comes from the transactional revenue, just slight seasonality per quarter. But to answer your question specifically, which is it's a fair point, you're right. As soon as we purchase a company or go into a building that acquire a new contract relationship with a new community, the most obvious areas we can actually impact is digitizing everything, and all of a sudden we can actually improve the customer service delivery, allow people to do things for themselves using our apps, and that translates into improvement of gross margin. So this idea of consolidating our back office continues to yield us more margin, and I couldn't even tell you that we're halfway through. I think we're just scratching the surface on that. It continues to improve. There's a much bigger conversation about AI that is actually going to make multitudes of progress in our ecosystem. And then on the selling of, once we digitize everything, selling products and services into these communities, it's a no-brainer simply because the amount of data we accumulate about the building, we can actually identify where it's not performing well compared to its peers when benchmarked. For example, there's buildings that are consuming too much water per square foot compared to another building across the street that we manage. Why is that? And it allows us to look and see where we can bring some, technology or improvements or process changes to that building to bring them back in line with their peers.
You mentioned AI, and we sort of talked about that before we started recording here. So I guess you're developing some AI stuff like most other companies are. This is sort of, we've talked about the past. Let's talk about the rest of this year and 2026. What should investors be looking for and expecting there?
The truth of the matter is everybody and their dog is doing something with AI, and they have to be looking at everything. But also the ugly truth is 95% of enterprise projects that are quote unquote AI deployments are failing. And we think it's because people are just want to plug that hole, check that box. Oh yeah, look at us, we're doing AI. And there's some obvious areas where you can go grab AI and slap it on. For example, all the websites that you go to, all the apps now have an AI agent that can just sort of help you navigate through where you're looking at and maybe answer a question or two for you. We absolutely think that's a play, and we are playing in that space. However, where we think AI can play a major role, and we think it's where a lot of some companies at least are missing the opportunity, is in redesigning your workflows around your service delivery. So we spent all of 25 essentially playing with AI, not talking about it, not putting press releases on it, just actually playing with AI and actually piloting multitudes of different things. How can it impact rental management? How can it impact the strata community? How can it impact condo preparation for a big project that's coming through the door? And we're accumulating a long list of interesting places where AI can actually deliver us, quite frankly, gross margin improvement, or immediately deliver us massive improvement from a service delivery in terms of customer satisfaction. If it doesn't hit those two boxes, we're not interested. This is pretty much give you an insight into how we're thinking. If it doesn't allow us to do more with less, quicker, with more efficiently, and frankly, drive to the bottom line, or if it does not immediately make the life of our residents, our tenants, significant, or our landlords better, if it doesn't do that, we're not looking at it. So the reality is, in accounting, there's tremendous opportunities to improve AP, AR processes. We're already one of the companies that uses digital technology to get quotes for different jobs. But imagine now if we can analyze these quotes and really give you a much better visibility on it instead of spending half a day or 4 hours looking at a big project quotes. Envision full workflows. You're a homeowner, you have a 2-bedroom, you want to replace the floors. Right now, even though we have great technology and you can open up work orders on the platform and has all the workflows, but envision if the AI will do all the heavy lifting for you, to tell you what you need to consider, to help you with vendor's choice, to all the stuff that maybe you and I are doing at the end of our desk with our chat GPT right now. Imagine if that has the knowledge and the consideration of your community, its regulation, it's the federal regulation, the provincial regulation, and your community bylaws in one mind. So it's a long-winded way of saying we envision a world in 26 where every building has its own AI agent walking around, running around through the data stack per building, and coming back and giving recommendations to whoever the master is, essentially the tenant, the landlord, the homeowner, or even our property managers, and help with those decisioning into and as we move up the pyramid to one AI that runs right through the organization. So it is a big opportunity of investment for us. We've identified where we want it to exist. We know what the prototypes need to do because we've piloted a bunch of them, and now we're going to throttle on that to. I think it can actually double our EBITDA numbers on its own. Like life with AI, life without AI. I actually think it has the
Holy
potential of
smokes.
doing that. I'm not saying it'll do that overnight. I'm just saying that
Yeah.
is the future. I'm absolutely 100% convinced that that's the upside from a future point of view.
So for next year, one of your big strategic initiatives that you're doing is you're rolling things up. You're buying up competitors, entering new markets with that. How is the M&A market looking in Canada? And as well, you have talked about entering the U.S. market. How is maybe that looking?
Yeah, and on Canadian side, it's lots of opportunities. We still think our national footprint now opens up more doors for us because once you land your brand and you exist in markets that you didn't exist before, all of a sudden competitors kind of identify that you've come in, you've made an acquisition, things went really well, and they think it's a legitimate option for them to exit. So we're active in that market. I think what we're doing right now, as you may know, we've done about 13 transactions to date. They've gone really well. We're amalgamating them, we're consolidating them, we're deploying things like AI and other products and services into our ecosystem. You'll see us in the first 6 months really focus on optimizing that engine of ours, going out and ensuring our organic growth strategy continues to work. And then we'll continue to look at acquisitions, but it's the first quarter, we're probably or two, we're now that I've said that, we're probably going to do something, but really the goal is to focus on improving gross margin and stabilizing all the acquisitions we've done and introduce the efficiencies that we're seeing. Like I said, we just scratched the surface on that.
So the next 6 months, call it, is going to be internally focused, get everything optimized and working well, and then maybe start looking out for new
And
acquisitions.
we're always in conversations. We're always
Yeah.
LOIs are always flying back and forth. And if we do see something that's juicy and like the entrepreneurs and like the company and like the footprint, we will make moves. So
Yeah.
we're well positioned for that.
And we've talked about this before, but just to circle back to it, the condo market, obviously in Toronto, is having a tough time. Vancouver, tough, not as tough. That creates both. Like you guys are a utility. No matter what, you still need someone to run the be a property manager. So it's just like hydro or internet now. But it also things are tighter, I guess, out there, and it creates opportunities. How is it affecting you right now? Is it what challenges or opportunities does it create?
Well, a lot of opportunities. So, in a nutshell, really what we're seeing is more condo inventory in brand new buildings sitting, not being sold. That's really the
Yeah.
opportunity. So, one of the areas we've actually did, and you'll see it in the slide here, we spoke about in our quarterly results, is we actually sat down, analyzed what are the needs of the developer in those environments, and we actually put out a number of. We've announced them already. They're already in the market. They're somewhat regional. Some of them, not all of them, are national. The idea is by 26, they're all going to be national. And what we've done is we've built a number of programs that are really focused to address this thing. So let's talk macro for a second. You've got high level of interest rates. A lot of projects that got started with high costs are now nearing the end, as in like either completed or about to be completed now or 26. A lot of that inventory is not moving. The developer was hoping to get $1,000 or $1,100, $1,200 a square foot. They're not going to get that. So now they got this inventory with a lot of money sitting on the sideline. What we're coming in and doing is we're giving them a bunch of products. The first product we announced is this concept of pooling. It's a rental pool. So we're actually taking all the condo inventory off the developer's hand and creating a rental pool. Think of it as like a mini REIT. and we're actually paying now based on the square footage of that. We're also working on rent guarantee programs. This is not guaranteed by Tribe, it's guaranteed by the developer selling units to the investors. So he or she are guaranteeing income for the first 12 months, 18 months, 24 months to the buyer of that condo, and they're handing over that management of that condo to us, and we're actually renting those out on their behalf. And we're also doing, and this is something that a lot of maybe viewers may not be aware of, there's a lot of developers that are halfway or just started the construction of their condo project and recognizing that it's not going to sell. So what they're doing is actually converting the project from a big tower of condos to a big tower of rental units. And in that particular case, it is apples and oranges. I mean, they are concrete and they're all units and they're going to be homes, but there's a lot of differences between the two. In that particular case, we launched that conversion consultation service whereby they reach out to us and say to us, look, these were our designs and our plans to create a condo community. Now we're moving from there to a rental community. What should we be contemplating? What should we be thinking? What should amenities look like? What are the budgets look like? Should we still have an opportunity to make changes? Do we need a lot of 2 bedrooms or 3 bedrooms or 1 bedrooms? So we actually help them with all that, help them with the change, and we actually take over the management of that building when it's completed. So all these products have been launched in the market post Q3 actually, and we're already getting traction on all of it. So that's kind of our approach to the macro, the changes that we're seeing. But I think you nailed it with your question. I will tell everybody, look, buildings need to be managed. That's not going anywhere. And more of us are moving towards buildings, living in buildings. A single family home. I got 3 children, or 3 kids. They're not children anymore, but 3 kids, and the odds are they're not going to be living in single unit homes, single family homes. They're going to be likely living in condos, and that is the future. That's all the land assembly and all the projects that are coming in. So I'm pretty bullish on the future of our company because all these buildings need a more efficient way to be managed.
Okay, we've covered a lot. Is there anything we missed before we wrap things up here?
Well, I would just say it's probably one of the interesting nuggets in the market that a lot of people don't know about us. We're on track to do, like I said, 34 million dollars of revenue this year, continue to grow year over year, EBITDA positive, very healthy, and in an industry that's growing, and we're trading at 14 million dollar, 15 million dollar market cap. So we think we're a great get. And I'd love to see people come in and learn more about it.
So yeah, I see some opportunities as well. All right, Joe, thank you. It's always fun chatting with you. Thank you very much, and talk to you again soon.
Thank you, Martin.